Hi everyone, it's Darren and Kristian, and we'd like to welcome you to the first of what we believe will be a nice continuing series. We're not sure what to call it because we're going to go into the laboratory with Kristian and do a bit of a deep dive into some of the economic data, market data, and other things that we've been looking at. And I've given Kristian a number of projects. So Kristian, many of you may know, though not all of you have had a chance to meet him yet. So Kristian joins us as one of the newest members of our team. He's a master of accountancy. He's a CPA, but he's not doing any accounting. He's joining us as our portfolio analyst and helping me with securities research, due diligence, risk management, and other things. And I've given him a couple of projects lately, and I thought it might be great to kind of, as I say, go into the laboratory. Let's look at some of the data and things that Kristian's been looking at to help give us some guidance and some wisdom and some insight into what's been happening and what we think might be happening next, because the last few months have been remarkable, actually, in terms of things that have been moving around. And many of you guys have asked for, I think, more information about what we're up to. So I thought this might be a fun thing to do. If you don't want to look under the hood of the car, thank you for tuning in so far. The rest will probably bore you. But for those of you who are keen, I think this will be a lot of fun. So Kristian, welcome. Thank you very much for the work you've already done and the work you're going to keep doing.
Yeah, thank you. I'm very excited to continuing to work with the team and work with all of our clients. So excited to get started and show you what we've been working on.
Perfect. So now somehow we made it so Darren has control of the slides. That's probably not a good idea, but I'm going to see if I can drive this thing. So you put a bunch of data together to do, as I say, a deep dive into what's been happening. So we'll start, as we always do, from a word from our lawyers that objects are smaller than they appear or larger than they appear, and 3 out of 5 dentists agree. And caution, items are hot. Okay, so moving on, your mileage may vary. So I think the first thing we wanted to zero in on is how much interest rates have changed. So do you want to talk a bit about what is in this slide and what you kind of think we should be taking from it?
Yeah, so the purpose of this slide really is to show what kind of environment we've operated in the last bull cycle here since the great financial crisis. And the way I would describe it is tremendous quantitative easing and extremely low interest rates. So any new investor that would have started since 09 essentially has operated through a period where interest rates were near zero for a very long time. And when they started to increase right before COVID, we know the government introduced extreme fiscal measures and monetary policy, including cutting rates right back down to zero to help ease the impact of COVID-19 and the various lockdowns. So when we look at interest rates now, and I've looked back at data since the 1970s, and this is the second largest one-year increase in interest rates going back over 70 years. That would be the period that we experienced in 2022. So when we look at this chart, it shows that really we're in a new environment when it comes to looking at interest rate policy. And it's not something that we're really familiar with when we look at the last decade plus of economic data and various asset class returns.
Yeah, and you're exactly right, because when we had the global financial crisis in 2008, 2009, we had all that stimulus, that quantitative easing. I love how they made up words that we now are in the dictionary. They put interest rates to really like wartime levels, lowest we've ever seen, so just above zero, which we all got kind of used to for a while. 2016, they said, look, we got to get back to normalized rates. They started, as we can see, a steady progression of raising rates back up. And then pandemic hits, boom, almost instantly we're back down. And I think where a lot of investors were struggling was they told us rates were going to stay. But there's video from just 18 months ago from the central bankers, both in Canada and the U.S., where they said interest rates will stay low. Our politicians said, hey, we should be spending a lot of money because interest rates are low. We can afford this. Now, people like me, financial planners, were like, that's not a good, no. I did a few Walking with Charlies where I said, no, we should be paying off debt when it's this cheap, not worrying about the financing costs. And look what's happened. So I think you're exactly right. This is the fastest I think we've ever seen about how rapidly rates have gone up. And they've done it from not just low levels, but from levels that they told us they weren't going to raise them from. But I think we want to put this in a context, right? If this is what we've experienced in the last 10 years, and especially in the last 1 year, but from a larger term perspective, and we're going to go back to the 1950s here, that 1 year surge still really critical, but it's just putting us back into kind of a normal range, right?
Exactly. And really, when we look at this chart here, going back almost 70 years, you can see that interest rate volatility is not something that's new to the markets. The markets had to deal with this for a very long time, up until the great financial crisis. And so we have various pockets here where interest rates rise, and typically that coincides with higher inflation levels. And then they are cut when economic slowdown occurs and they need to stimulate the economy. And this cycle continues throughout history, really, up until the great financial crisis. And when we look at this chart here, a thing that I would also like to point out is the shaded areas. And the shaded areas in this chart represent recessionary periods in the United States. And a lot of them, and we're going to get to an inflation chart here that I think will also be helpful, will show you that good side inflation is not something that's new to the economy. And a lot of that precipitates a recessionary period. So when we look at the 1970s, for instance, we have the collapse of the Bretton Woods arrangement. We have OPEC oil collapse and supply issues with oil. 1980s, we have Iranian oil concerns. 1990, again, we have issues from elevated interest rates throughout the 80s and loan and savings crisis. So really, we've had issues throughout the global economy, and specifically when we look at U.S. inflation and interest rate data, that have led to elevated interest rates over time and elevated levels of inflation.
Right. So I think this is really helpful. I'm glad you included this. So it kind of reminds investors that, we went through this period of really low rates for a long time, but so the surge and the volatility of rates might feel new to many people, but it just may be new to them, but it's not new to the market. And even though rates are higher today for many people, they're not high in a historical context, right? So, and I think we need to anticipate rates continuing to be volatile like this, because if inflation changes, as I think you're going to see in the next one, this whole picture could change too, right? So why don't we, I think that's the next slide we've got, which is inflation, which is really the response. This is what causes those rates to change, right?
Exactly. So, and we have another chart after this as well that will show you the movements in interest rates relative to inflation. And certainly to an extent, interest rates are the monetary tool used by governments to respond to inflation and price pressures on consumers. And so when we look at inflation from a historical lens here too, we can see that we're really operating at quite low levels when we're looking at core CPI, and that's the Consumer Price Index, changes year over year. But when we go back through history, there are periods where inflation has risen rapidly. And so even though history may not repeat itself, I think it's helpful to know, given the amount of data that we have access to, how various asset classes, how equities performed during periods of rising interest rates and rising inflation, which are not new to the market, even though it may feel new, given the environment we were in the last 10 years.
Now, I'm glad you also pointed out that we've been through a very long period of low inflation, which was, call it, all the way through like the 90s. I've been arguing that I don't think we should assume, even though the target inflation rate is 2%, I don't think it's reasonable to assume that we're going to get back to that anytime soon, because a lot of that came from huge advances in productivity growth through technology, which now we all have, so those are kind of behind us, but also through the exportation of inflation to places like China, because as they were building out their economy and building bridges and highways and cities and things, they bought so much stuff, the rocks and trees and things we have in the ground here in Canada. So we exported a lot of our inflation to that part of the world as their economy was absorbing it. As that kind of moves through, that inflation isn't contained to those countries anymore. And also there's a question of just how much additional work can be sent offshore between now. I think a lot of supply chains are saying maybe we need to worry a little less about efficiency, more about protecting them. And also we don't have a young population in the West. We have an aging population. So how are you going to teach Darren to use a new computer? I don't know. So there's a lot of arguments that say the productivity gains and things that allowed inflation to stay low in the West are behind us. So I think I'm going to argue that we're going to be in a persistently higher structural inflation level than we've seen for the last 30 years. That's my assumption, and that's kind of how we're positioning things. And I think that matters for the next slide, which is how inflation and interest rates work together, right?
Yeah, exactly. And I think just going back to your point there, a lot of what I've looked into is secular trends. And so those are trends that we expect to persist not over the next year, but over the next decade. And things like a globally aging population and the impact on workforce labor supply, reshoring of supply chains and deglobalization from geopolitical tensions that we're seeing with China and Russia. Those are all issues that we think are going to persist, and there's really no indications that they won't persist. And so when we think about inflation and what's allowed it to be quite low over the last few years, there's certainly now an argument to be made that even if inflation were to come down in the near term, it can reaccelerate a lot faster than it had in the past. And so looking
all
at
those things that allowed inflation to get absorbed are not, it's like a sponge, it's already full. Like it can't absorb much more of that.
Exactly. And so looking at this chart here, this just goes back to my earlier point of, how interest rates and inflation have trended over time. And you can see they've generally mirrored each other with interest rates lagging inflation. And that just speaks to the monetary policy response to wanting to lower high inflation to reach target rates. And the Fed's stated target rate is 2%. And I think we have a chart coming up here which will just show what the Fed expectations are for interest rate in the interim here. So here we have,
as you said it, I made it happen.
Magic. And so here we have core PCE. That is the Fed's preferred metric of measuring inflation. It essentially removes more volatile components such as energy and food and looks at durables, non-durable goods, and services. And so the target rate for the Fed has for a long time now been their stated target rate of 2%. And when we look just based on what the Fed is telling us, we're not going to reach 2% until really 2025. And so a lot of that is being driven by service side inflation. And I'm sure you've seen a lot of reports come out on news and economic channels about historically tight labor markets and consumer surpluses as a result of excess monetary supply during COVID. And so a lot of that needs to continue to be filtered through the system, and that'll lead to structurally higher inflation in the near term. And a lot of those secular trends, to the extent that inflation may fall over the next 1 to 2 years, could cause it to reaccelerate quite quickly thereafter. And so another thing I wanted to point out is if we look at the bottom chart on this slide, is how inflation expectations are evolving. And I'd preface this by saying we need to be really data dependent here because we get so many new data points every month, just as the Fed is. And the Fed has consistently said their projections are data dependent and their rate of interest rate increases will depend on new and incoming data. But we can see in just a span of 3 months, the Fed was projecting a majority consensus opinion of inflation for 2023 end of year closer to 3%. And now a lot of Fed respondents and board members have moved further along the curve, where we're looking at 3.5, 4%. And so that just kind of speaks to what we're seeing in the near term here of issues bringing down services side inflation and inflation remaining a little more elevated in the near term until goods side pressure can come down even further, which we expect they might. And Darren,
as supply chains get fixed and things, that should help, right?
Yeah, but services will certainly remain a little more difficult for the Fed to tackle, and that's one of the key areas that they're focused on. And Darren will also speak to this. We had a fantastic one-on-one conversation with one of the largest fixed income managers in the world, and certainly there are expectations for goods side pressure and specifically shelter to allow inflation to come down in the near term, but that services component and specifically labor will continue to remain an issue, and those structural trends can remain an issue for the next decade.
I also think it's important to mention, like from a planning perspective, that what government is measuring as inflation isn't necessarily the same as what our lifestyles are experiencing. You mentioned at the beginning about what core inflation is. So the core inflation numbers that governments use for measurement, they remove the most volatile items from the calculation, which would be food and energy. So energy for heating your home and getting around, they take those out because they're too volatile. So they're looking at everything except that, which is frustrating. So, I used to joke that when they said inflation was low, I'm like, well, if you're willing to walk, starve, or freeze, I guess it's not that high. But what we've also seen, and we saw in that earlier chart, is that the biggest components of inflation right now, the highest, fastest growing things in cost are energy and food. So even if some of those other components come down, I think we're going to continue to see that the average person's grocery bill and gas bill and home heating bill is still going up at a rate higher than 2 or 3 or 5. So when we do our projections, and Ryan and Carolina do their projections about how we're forecasting someone's lifestyle expenses, we're going to keep dialing in a higher number than I think the central bankers are telling us, because real life isn't the same as their textbooks, right? So
Exactly, and when we look at CPI, Consumer Price Index, it's based on the average consumer's consumption of goods and services. So even inflation itself could really vary from consumer to consumer, person to person, depending on their spending habits. And so one person may experience drastically different inflation effects than another.
And no one watching this is average in any way, so...
Exactly. And so
too.
Moving on here, these are just the current market expectations for where interest rates are headed. And I thought this would be helpful to show. And if you weren't watching interest rate movements in the futures market closely over the last 2 months, you really wouldn't know much has happened, because we entered the year here with the market projecting cuts by the end of the year, and the Fed being quite hardline and saying that we're not going to be cutting interest rates and they're going to be staying at elevated levels. And we reached a short period towards the end of February and early March where the market was quite aligned with the Fed expectations, and they were pricing in additional increases, and they were saying that it was going to stay elevated there for the period that the Fed had indicated. But as we know, with recent headline news such as Silicon Valley Bank and Credit Suisse, there was a little bit of distress, especially when we look at yield markets and futures markets. And so now they're back into pricing in almost 100 basis points cuts by the end of the year. And the Fed's recent meeting, which just happened over a couple weeks ago, and it happened after the banking issues, they're still saying that we're going to hold rates at higher for longer. So there's certainly disjointed opinions with the market and what the Fed is saying, and that just adds an added level of complexity for us to navigate here as we continue to plan around how we want to position our portfolios.
Yeah, and you're exactly right. There's been this big disconnect between the market thinking one thing and the Federal Reserve telling everybody something else. It's like, why aren't they listening? So I think we're going to make the decision, I think, to listen a little more to what the guy pulling the strings is saying, but being mindful of what everybody in the audience seems to be thinking. But it seems like the people in the audience, the bond investors, are not paying attention too much to what Powell's saying. I guess they're all following the data, but everybody's got a different interpretation. But at the end of the day, only Chairman Powell hits the buttons. So we'll be paying attention to him, not the market very much. Okay, the next slide you have is also quite interesting, because this is all your work. So we're going to, as I say, kind of open up the hood a little bit and show one of the spreadsheets you worked on. And I'd given you a bit of a project to do a few weeks ago, right? Do you want to maybe share what the project was?
So given this new environment that we've prefaced here of maybe higher inflation, higher interest rates.
New in the last 10 years, I think, is the right.
Yes.
Because we talked about the whole context, but new in the last decade, yeah.
New in the last decade. We're prefacing it by saying that we think we're in a new environment relative to the last decade, relative to the last bull cycle. And so what does that mean for portfolio positioning? And one of the things that you've had me look into here, and this is one of many spreadsheets, is how asset classes have performed over time if we go back to that period in the 50s that I indicated. And so what I was specifically isolating for, and this is one of the spreadsheets, is that what are periods where interest rates have increased rapidly? And you can see that by the highlighted text, and this data goes all the way down to present day. So this is just a general screenshot just to give an example what I was looking at, what we were examining. And so how have asset class returns performed under these different environments? And certainly the next few slides here, we have some interesting insights, and so that will inform our opinions. But certainly I just wanted to show some of the background research that went into forming some of our opinions and what we were looking at.
Yeah, and I asked you to do this project because, like, look, Mark Twain has a great comment. He says, history doesn't repeat itself, but it sure does rhyme. So the fact that we've had the fastest increase in interest rates doesn't mean it's never happened before. So I was curious, and having been through 30 years of this, But even still, we've only seen interest rates have this kind of rapid increase a few times. So I thought, let's actually go back and think about what we can learn, because this is the other truism about what people learn from history is that people don't learn from history. Let's not be like that. Let's just see what some of the asset class performances were, so we can be mindful of, as our positioning, like what worked the last time this stuff happened, and will it work again today? But it gives us, I think, a place to start by having some insight into when this happened before. What did we learn? So let's jump to the. So again, you've done lots of work on this that's helping to inform us about what investments and asset classes and things are interesting. And this is one we're going to do another video, I think, about some of the points in here about equity styles, like what is what's momentum, what is quality, what is high dividend. So we're gonna, if you're not sure what those terms are, don't worry, we're gonna do a little video on that. But do you want to just talk a bit about, assuming I've already told everybody what these styles are, kind of what some of the differences are in terms of at different points in time, different things seem to work.
So what's nice about the equity markets and various asset class markets is that we have a wealth of data. As I mentioned, that goes back a long time. So it's not like we're relying on outliers or singular data points. And we have really a lot of data points to inform how well returns are correlated to different environments. And the environment that I mentioned we're looking at is rising inflation, is certainly rising interest rates, and then we look at the period right after that. So given this data, this is basically showing us where can you take active risk and quality momentum. Darren mentioned we can definitely go into that in another video because they require their own explanation. But in a sense, it tells you what types of factors can capture returns well in these environments. So quality, momentum, and high dividend yield, to an extent, have really performed actually quite well when we're looking at higher inflation, lower growth, and to an extent, they help capture even when economies start to heat up and they start to do well. And so really, when we're thinking about portfolio construction, we want to be taking active risk into making sure we're capturing these types of qualities in the companies that we select. And another thing that's worth mentioning is the sector-based return. So on the right-hand side of the chart here, when we're looking at sector-based returns, you can see it's a kind of spread all over the place. And one sector doesn't perform well in every environment, not like active equity styles. So you don't have a sector that performs really well when the economy is doing really well, but also performs extraordinarily well when there's low growth and high inflation. But there are some sectors that do relatively better than others. Energy is a great point because energy itself is really highly correlated to inflation. And so it does really well in inflationary environments, but it also does well to an extent when growth is increasing because consumption increases and the need for energy in turn increases. Healthcare was another asset class that its average annualized returns, when I was looking through the data, performed consistently well throughout many periods. And certainly, I think there are some secular trends, like we mentioned, such as a globally aging population, that lends itself to healthcare performing well across different environments. So broadly speaking, we can see that.
And just before you go on, we had you and I had a really good Tuesday this past week, where or Wednesday, excuse me. We had a really good day, and one of the conversations we had, one of the private meetings we had, was with one of the world's largest and most successful equity investors. We talked to some of their senior people in their Toronto office, and then later that day, just almost by fluke, we were able to have a private meeting with one of the world's largest and most successful fixed income investors, who, just a quick story, happens to be Canadian. He's not based in Canada, but he happened to be in Toronto because he has a home in Muskoka and he's visiting family. It just happened that he was in Toronto the day we were, and we were able to facilitate a one-on-one conversation with him. So we had a really good day of getting privileged access. But what's interesting is the healthcare one came up as one of the favorite ideas right now from one of the world's leading global managers, that's one of their key places they're seeing opportunity, and it aligns on a lot of reasons. So I'm glad that in your chart, we already kind of knew that going into the meeting that was going to be what we thought was a popular idea, and they confirmed that.
Exactly. So it's always nice to get affirmation from, as you mentioned, one of the leading equity managers in the world. And Certainly, when we look at like a healthcare entities, they actually tend to capture the qualities that we would expect to perform well. So eventually, those quality decisions, those high dividend yield decisions, really end up informing a lot of our sector-based decisions. They work in tandem. So, when we're looking at this chart holistically, what this gives us is information of how we want to position ourselves, and this leads us into a value versus growth discussion. So, when we're looking at the period over the last 10 years, and we'll get to that chart in a second, we can see that growth has outperformed and it got relatively cheap for a period because technological advances were quite extreme, and to that extent, companies were growing at very rapid rates.
Yeah, so
But
imagine
now we
Apple
find
or
ourselves
Amazon over a
yeah.
utility, right? A utility would be a value company, and growth, and Apple and Amazon would be growth companies, right?
Yeah, at that time, for sure, they were growth companies because they were growing at exceedingly higher rates, and they weren't at the market caps they are now. They've experienced multiples of returns over the last 10 years, and they've been the best performing equities by far. But where we position ourselves now and where we see ourselves is that value actually looks pretty cheap. And that's not to say that growth shouldn't be captured, because there's still a lot of secular trends that growth will help capture, like aging populations, for instance. And we think of AI, which is definitely the topic du jour nowadays. That's what we think of when we think of growth. But value seems to offer a lot of great opportunity at these levels. And when we look at sectors that help capture value, again, we're looking at things like energy, which performs well in high inflation environments.
And by the way,
Healthcare,
has had a 30 years of underinvestment. So that's
exactly.
enough. So I've actually stayed out of energy as an investor for almost my entire career. Now we actually think it's interesting for the exact reasons I stayed away from it. It was underinvested, terrible environment. But now, because of that underinvestment, there's a bit of a scarcity issue. So we've been increasing our allocations to energy at I think the right time.
Well, exactly. I think when we look at portfolio positioning, you were probably a bit ahead of the curve when you started increasing allocations to energy very early in 2022. So you helped capture a lot of the upside that happened over the last year. And certainly we think that those structural issues can lead energy to sustain some elevated prices. And so those elevated prices get fed back to the companies that produce oil and natural gas. And some of these other entities here, I think you also see from a value perspective, really remain key components of our equity portfolios over the last while. Tech, for instance, healthcare, even though they're looked at as growth, they still do relatively better than some very sensitive sectors of the economy. Another one is consumer staples and financials. You can see really help capture value, and you'll see that reflected in our underlying equity positioning. So we can
So
move
why
on.
don't we move on
Yeah.
to, let's move on to the next slide. Where's the button? There we go, Darren. I think this is one of my favorite charts because it informs, I think, kind of one of our core philosophies is why we believe that one of the foundational pieces of every portfolio is go and get dividends. I don't care how old you are. If you're 25, you do this. If you're 75, you do this, or 85 or 90, you want to have dividends as a key part of your portfolio. Do you want to just take us on a bit of a walk through what this chart's about?
So this chart is based on the S&P 500, and it shows us what percentage dividends contributed to total return. So total return is the actual amount of money that any investor would have received over a given period from owning the S&P 500.
Yeah, so
And
if I
when we
bought it at
look at
$10 and it went to $20, that's my price return. Then if I got $2 of dividends, that's all. That's in addition to that.
Yes, exactly. So when we're looking at these charts, what's interesting here is again that period that I mentioned from the Great Financial Crisis where dividends really did not contribute much to an investor's total return profile. They only contributed 16% in the 2010s and 21% in the 2020s so far. But when we look across history, the average is actually 38%. So dividends were historically almost double the importance in terms of a total return profile than they have been this last bull market cycle. And another thing to mention about dividends, I think this will speak to, why we like dividend growing companies is dividend growing companies often attract and capture those equity styles that we mentioned do quite well, such as value and quality. So when we look at dividends from a holistic picture, they actually do a number of things that we think position the portfolio quite well, apart from our expectation that we actually might get a little closer to this 38% average than we have been the last 10 years. And so not only does that become important, but dividends themselves offer quite a bit of downside protection when we experience more volatile markets, and especially when we have more inflationary and interest rate volatility added to market conditions.
Well, I learned this kind of the hard way because a good chunk of my career was in the early 2000s. And in that period of time, it was called the lost decade because if you didn't have dividends, you literally didn't have anything. So people learn the hard way, especially, and what was interesting there was coming off the back of the 80s and the 90s where dividends were important, but not as important as, hey, price change, speculation, I want to make money on the stock going up. We had 2 decades of people saying dividends don't really matter. They forgot the lessons of the 60s and 70s, and they chased things for price performance. Well, that worked out really badly if you didn't remember your history and you didn't hold dividends in your portfolio. So that's why we've learned to do this, that over long periods of time, dividends matter a lot.
Yeah, exactly.
Okay, let's go to the next one.
So another area that we're definitely looking into with increased focus is the fixed income markets. And the easiest way I can say why we're doing that is because for the longest time, yields were extremely low. And so if you wanted to go, and when I say the longest time, I should preface again by saying that's the period that we've been referring to since the great financial crisis where interest rates have been really low. So
yeah, and for the last decade, we've run very, very light fixed income portfolios to the point where my compliance department keeps thinking I should add more, but I keep telling them their textbooks may need to be refreshed from the 1960s. But you're right, we've been very light on fixed income. So just like energy, where we stayed away from a long time, conditions have changed. So I also gave you this project to let's look at the fixed income market. Now that rates have moved up, this is now interesting in a way it hasn't been interesting in a decade. So, and I think it's important people see just how complicated the fixed income market is. So sorry to interrupt, but I think that's just a good place to preface why we're looking at this with such focus.
No, exactly. And so now that we're in this different environment, as we call it, with elevated interest rates and possibly, longer term, more central bank intervention and a period of maybe rates being a little more elevated than they have been over the last decade, fixed income now looks a lot more attractive than it has at any other point in the last 10 plus years. And I've had conversations with several fixed income managers, and their mantra usually is now, if you don't like fixed income now, you'll never like fixed income because of where yields are. And so when we look at it from that perspective, we can see that, and the chart on the right I think is particularly important because it shows us where if yields were to fall, which typically leads to price appreciation of fixed income, there's significant upside benefit through across most fixed income classes.
Right. So just to remind everybody, when interest rates go down, bonds go up. So we've had this big move up in interest rates. Bonds do terribly in that environment. Indeed, the bond aggregate index, so a measurement of the broad bond market in the United States, had its worst year on record in 2022 because rates went up so fast. But now that looks like that's mostly behind us, if interest rates stay flat or start to decline, this really becomes a return opportunity.
Exactly. So starting at an elevated level of interest rates and just looking at it from present day, there really is an area of opportunity here that even if rates were to rise more, there's a lot of downside protection, and the break even, it becomes a mathematical equation at this point where the break even points in fixed income are a lot higher than they have been in the past. So it requires a lot more upward movement to realize losses in the fixed income space. So when we look at it from that lens, there's quite an attractive risk reward dynamic that hasn't existed over the last 10 years. And there's an opportunity to capture quite high yields and provide pretty stable yields when we're looking at complementing our equity portfolios and positioning.
Right. So very asymmetric period of time where we can see those gray bars if rates went up by 1%, how badly would we be hurt?
Yeah.
Not very badly. But if rates went down by 1%, lots of upside. So it's really interesting that if just one little move in either direction, big returns one way, not a lot of losses the other way. So really timely that we're looking at this now. Okay, next one. This is interesting because we've curated a bit of a suite of some of our favorite fixed income managers and mandates, and we used one of the companies that helps us with data analysis, and we gave them some of our favorite mandates and managers because we want to make sure that the whole point of diversification is different eggs in different baskets, right? So what did we come back with? I think this is fascinating what we got back. Do you want to take us through this one?
Yeah. So we've actually been on a project of going through several stages of risk analysis, portfolio analysis through various tools and providers. And this one I think is particularly interesting in terms of its visualization because it just shows us here how our fixed income positions, our fixed income sleeves perform in different environments. So one area here is how do we look at the correlation between our fixed income positions and the equity markets? And certainly here, when we're looking at our fixed income positions, we see that different sleeves are more highly correlated to equities, so they capture more of the upside when equities go up. But at the same time, they are a little bit more correlated on the downside, so they're capturing a little bit more of the equity risk. So this just helps us really inform how we're thinking about how we can diversify our equity positions with the proper fixed income tools. When we look at the other chart here, it tells us about oil, and oil conditions, as I mentioned, are really highly correlated to inflation. So in a sense, this acts as a bit of a proxy for how we expect our fixed income positions to perform in inflationary environments. We've done other testing, and so this is just one example, where we look at how do our fixed income positions perform when spreads widen. And to that extent, what is our downside look if yields were to rise, yields were to fall, if high yield spreads increased or high yield spreads tightened. And so all these data points really help us inform our decision making as to how can we best align ourselves to current market conditions, but also expected market conditions over the coming years.
And I think this also helps demonstrate why, particularly in our pool fund, we use multiple different mandates and managers because we're expecting different behaviors depending on the factors. And look, I can't predict the future. We can just make some educated guesses. So, that's actually one of the key hallmarks of this is we need to stay diversified because we're not always sure which way the ball is going to bounce. So even though we think this, we got to also protect for the other one. So speaking of diversification, one of the things I've talked about this to clients for many years about some embedded risk in the equity market. So we're going to leave the fixed income markets now for a minute because this is a big project we have, still a work in progress. But this is something else that's changing that, again, haven't seen this for a long time, but something I've been talking about and a bit worried about. Looks like we're on the cusp of this changing. So, which is the dominance of a small number of companies that's moved all the indexes around. So do you want to take us through this one, please?
So what I really like about these charts here is one, when we look at the periods of the 2020s, specifically in most recent time, PE, which is price to earnings, reflects the average multiple of the market if you're trying to base it on value. So there was a lot of multiple expansion, and this goes back to our earlier discussion of, maybe price return and multiple expansion won't actually contribute the same proportion as dividend expansion. And total return profile may be driven by more yields. But the better part of this page, and certainly the charts that I think are really speaking to that point, Darren, are the right part of this page when we look at large cap outperformance. If we isolate for the period that we've been talking about over and over, the last 10 plus years, large caps have significantly outperformed mid caps and small caps. So to this extent, large caps look like the place to be. And a lot of this large cap outperformance is driven by what we term now our mega cap stocks. So our FANG stocks, Apple, Amazon, Google, they experienced 10 times plus returns over this period, and it performed extremely well, and now they constitute really large weightings in the S&P 500, and so they've driven quite a bit of these price returns over the last 10 years.
Now, by the way, for investors, this is maddening because, it's right now you can make a really good argument and say, Darren, why do I need you? All I needed to do, if I had a time machine, is I should have shoved all of my money in Apple and Amazon and told you to get lost. Don't do anything but own those. And history says, looking back, yeah, you shouldn't have owned anything but that, really, maybe a couple of others. The problem is that you don't know that going in. So what if you did that with Nortel and Enron? Because they also exhibited these periods where they became the dominant performers and all the money went into them and they sucked up all the oxygen, and then holy cow, did that ever work out badly. So even though we've seen that dominance in the past, if you wind up chasing that and overweighting to that, yeah, that might look good for a period of time, but history tells us that actually leads to the biggest mistakes. So we're seeing lots of people trying to chase that stuff, but I think we're also, like in the fixed income market, onto a really interesting point where that could be about over. Because when we look at it a longer period of time, which is the next chart, what do we see?
Well, if you look at it a longer period of time, and this is just extending it a few years, and for full disclosure, I looked at asset class data, again, all the way back to the 1950s, and small to mid caps performed actually much better than you'd expect in inflationary periods. They held up better, they outperformed large caps, and if we look at it just from 1998, small caps and mid caps outperformed large caps. So it's really an anomaly the last 10 years when we look at the total return profile of these other asset classes going back 25 plus years. And to your point as well, when we have leaders of one bull cycle, such as Enron and Nortel, they are very rarely the same leading equities of the next bull cycle. So really, when we're thinking about this from a portfolio standpoint, is where can we capture the most value in our positioning, and what do we expect to perform well when we're looking at historical data and not just the last 10 years?
Right. So it certainly looks like that pattern, which was an anomaly, but everybody thinks it's normal, that could be ending too. So we've been manifesting some of these items into our portfolios. We've moved into energy, which is the first time in a decade. We did that a while ago. First time in my career, we took a big weighting in that. We've been dramatically changing our fixed income allocations. We look to continue to increase that in a diversified way. We've been making some adjustments around our equity exposures because we think this change is going to be a big deal. We've added for the first time in a long time some small cap and mid cap exposures. I think we also want to get into this next one, which is we're going to talk a little bit more about some of those style benchmarks, right?
Well, yeah, to an extent, when we look at these asset class performance from a small, mid, and large cap perspective, it just reiterates what we're seeing and how the markets have trended recently, and why we think this is actually quite a good opportunity from a fundamental value perspective to begin looking at small and mid caps. So when we look at their market peaks, so in this case, JP Morgan is going to use February 2020. Small caps have really, in the growth category, only recovered about 5.5%. And across value, blend, and growth categories, so now looking at the right side of the page, they're trading below their 20-year average price to earnings ratios. But then if we look at large caps, for instance, they are trading at quite elevated metrics relative to their 20-year averages. So a big thing, and I know, Darren, you talk about this a lot, is looking at entry points and looking at relative valuation and seeing, how can we derive value and what seems appropriately priced. And certainly from that perspective, small caps add another compelling argument to their case because they're trading at relative valuations that are quite attractive. We've seen that they perform, if not better, at least equal to large cap equities over a longer period of time. And data would indicate that they're actually quite a bit more resilient to large cap equities in periods of inflation. So just bringing this all together, there's just several different lenses that inform these decisions as to why we think these asset classes will perform quite well.
Okay, so that was a lot to take in. So I'm going to thank we're going to close it off now by saying all this stuff goes into the mixer. We've only given you a slice of some of the work that Kristian's been doing with me. So Kristian, thank you for showing us your homework. Thank you for taking us on this tour of your laboratory and some of the outputs. And so appreciate the work you've been doing. So thank you.
Oh, thank you very much. I'm happy to go through this, and I look forward to hopefully doing some more down the road, and hopefully by then we'll have a name for this little show of ours.
I'm liking deep cuts with Kristian. I don't know. So why don't I ask you that have watched this far? Thank you very much for staying tuned. I hope you like this. And I'm happy that we always are open for feedback and suggestions. So maybe help us with what we want to call this segment and ideas for what you'd like us to cover next. Kristian is like full-time on all this stuff, which is wonderful. So it frees up our time to look at more ideas in even more depth and do even more homework for you. So thank you for your time. Thank you for watching. Thank you for your trust and confidence. Talk to you guys again soon. Thank you.
Thanks, everyone.